Like and subscribe to my channel and click the bell icon to get new video updates.
First quarter update outlook 2023 economic background. We started the year with a discrepancy between market and Federal Reserve expectations for the projected interest rate path. The Fed had set a target rate of between 5% and 5.25%, which it would hold for the rest of the year. Market expectations, reflected in Fed funds futures, were that the Fed's aggressive rate hikes would push the economy into recession before year-end, forcing the Fed to cut rates through September. In the first 80 days of the much has changed in 2023. Fed rate hike expectations briefly rose to 5.75 to 6.0% as a possible final rate, and then in March, the negative impact of rate hikes hit regional banks, with 3 banks forced to take over by regulators, and investment coldness reigned throughout the banking sector, suggesting the likelihood of a possibly not superficial U.S. recession heightened. The Fed just announced a 25 basis point rate hike for March, taking rates to 4.75% 5.0%, but the market believes there is about a 90% chance this will be the final rate hike. Despite Chairman Powell's insistence that rate cuts are not on the agenda for 2023, market expectations point to rate cuts as early as June, culminating in a policy rate of 3.25–3.5% by mid-2024. What does it all mean? Before discussing the impact of rate cuts, it is important to clarify that these expectations are very volatile and fluctuating, as evidenced by the dramatic changes we have already seen in the first quarter. The Fed maintains its own forecasts, shown on its dot plot charts, but experience teaches us that actual policy moves rarely turn out the way the Fed envisions them. However, the Fed funds futures market gives us a glimpse of how the market's collective intelligence assesses the current economic outlook. At the beginning of the year we set 3 implied paths for interest rates in the economy. First, the Fed's view that the economy would survive rate hikes above 5%, a level that would be sustained well into 2024 without year-end cuts.